rate cut traditionally has been a sign for the market to really accelerate the downturn. So I think that would be an official acknowledgement that we have been in a recession. Everybody claims we're not in a recession. I've been saying for the last year, we are in a recession. The leading economic indicators came out this week. They were down now for 24 months. They've been going down every month. Leading economic indicators are down. And now the charts tell us that all of the stimulus, which is from 7 to maybe $9 billion, is used up. People got that money. Many people said, oh, I don't have to work anymore. I got all the stimulus money from Washington, and suddenly they have spent it all. Then the next phase for people is to go to their credit card, take out their credit card loans. So now we have an all-time new high. It's over $1 trillion, 1.14 trillion of credit card debt. Money that people have borrowed against their credit card, and they're paying maybe a 25% interest rate. When you pay 25% interest, it's a prescription for bankruptcy. There's just no way you can pay 25% interest and stay alive. So this is the next phase. And people have run out of money. So now, but they still didn't want to work. Employment numbers really tell me that. I don't use the official numbers published by the LAS, and I don't listen to those at all. I go to their website. On their website, they have to be more honest. So the headline number that you see on TV is always false. They publish the false numbers in inflation, in all the important metrics. Don't pay attention to the headline numbers. Look behind the numbers, and you can really get the accurate information if you spend about 15 minutes on the BLS website. That is important. People should take 15 minutes of their life to look at what their future looks like. But people don't want to do that. They rather go to a baseball game or a football game or whatever, and that's really worthwhile doing it. I think right now, I wrote that last month. I said the bear market is now starting underneath the surface. Okay. Bear markets always start ahead of the actual visible numbers, So we wrote in July, there's going to be a big downturn in the market in the second half of July, which then we got with the yen carry trade. We didn't know it was going to be a carry trade, but it happened. And then it's going to be that last hurrah rally in August. And the last hurrah is where they suck in all of the reluctant bulls into the market. Everybody gets very euphorious. I use that word. Interestingly, a very good analyst that I respect for many, many years, he used that same word recently, and euphoria. So we're really reaching now the euphoria stage. And I predicted that this is how this whole thing is going to end. Euphoria. Everybody's going to get very bullish. And it would probably be a good trigger is the NVIDIA earnings when they come out this week. And then you have to really have a good strategy to make money in the bear market. We have made money for our valued subscribers in every bear market in 48 years of existence of my firm. So that is important. It is much easier to make money in the down market because stocks and these investments go down much faster than they go up. Have you ever noticed that? The first massive selling. And I said, this is a maximum selling that we're going to see for a little while, but it won't be the final thing. There's going to be a rerun of that. Let me just explain the yen carry trade, which I also did in our Wellington letter in our trading service. We also have trading service for shorter term oriented people. The yen carry trade was so attractive for all of the big hedge funds and the big players in the markets. They would borrow yen, and they had a 0% interest rates in Japan, which is by the wisdom of their central bank. The central bank bankers, their head guys always change. They always get thrown out when something goes wrong. Then they get a new one who, again, makes the same mistakes. When you consider Japan, the government owns via ETFs over 70% of all the stocks listed in Japan are owned by the government via ETFs. It's ridiculous what they're doing over there with monetary policy. And they've been doing that since 1980 when their markets crashed. So that's a long time to do all this manipulation. But anyway, the hedge funds would borrow yen at 0% and convert them to US dollars, and then they would make a positive carry. Then they would invest it in US treasuries and T-bonds. They might make 4.5% interest. So they pay zero interest, they make 4.5%. That's an infinite positive carry, as it's called. It's the easiest way to make money. You have to be an idiot not to make money in that trade. When the yen interest rates started rising, because the central bank in Japan made the decision to let interest rates rise, then, of course, the cost of the money on that trade, which was done maybe with 100 or 200 or 300 to 1 leverage, huge leverage, So they let interest rates rise, and suddenly, wow, your cost of money is getting higher and so on. And pretty soon, the losses on your positions higher than the equity you have in it. And pretty soon, with that kind of leverage, you're going broke, and that is a danger with the carry trade. You're going to go broke. You're going to lose everything you have in there and much more. And then you're going to get margin calls that you cannot meet. If you're an individual, they go after your house. Most people don't even know that. If they have a margin account, they can lose their house. If they get a margin call, they can't meet. I had a discussion at lunch. That was in 1987, a few days after the 87 crash. Went down 22% one day. And he came to the city where we had our office, and we had lunch, and he said, "Oh, I'm going around the country foreclosing on houses." And I said, "Foreclosing on houses? I didn't even know you were in real estate." He said, "Well, we're not, but we're foreclosing on margin calls." I could not believe it. That was incredible. You cannot get loans. See, that's one of the problems right now. If you're a developer, you cannot get a loan, okay? You can't get the initial construction financing because you cannot get the takeout financing. Takeout financing is given by banks when the building is completed, So they can't get the construction to finance the construction. They can't get the takeout financing. And if you have no credit expansion, then everything goes to hell. Pardon the expression. That's why what is ahead is going to be pretty bad for people who are not prepared. But bear markets can be so profitable. In 1978, there was a high inflation period. We said the U.S. Treasury bonds will lose between 40 to 50% of the value. Now, I had asked to have presentation at the board of directors of larger entities and so on. They were loaded up to the gill with U.S. Treasury bonds. And I said that they thought it came from Mars. Treasury bonds could never go down 40 to 50%. Well, they went down 44%. So I was right. But then came the other side of the coin. A few years later, and that was 1982, we gave an opportunity of a lifetime bicycle for bonds. This is it. Bonds are going to have huge rallies. And we even recommended zero bonds, which have the coupon clipped from it. It's like a leveraged T-bond. And we wrote it would go up about 10-fold, which, is quite a bit. Actually, over the next 40 years, they went up 40-fold. Can you imagine the gains on that? Simple trade. You buy it, you can go play golf every day. Don't worry about it. You don't have to watch your computer or financial TV. It was very simple. We're going to have an opportunity like that again someday, but it's going to be more volatile this time. We do a lot of cycle work, short-term cycles and long-term cycles. The biggest long-term cycle study we ever made, that was in 1980. Gold had hit $800, and we got a sell signal start going down, but it went through 694. We said, that's it. We're now in a gold bear market. And our cycle study, which went back 200 years in the U.S. and another 200 years in gold trading in England. And we found this cycle that was pretty dependable, a 20-year bear market. And we said it's going to be a 20-year bear market, and gold will probably go down to $300. And it actually went lower. And sold all of our call options on our mining stocks. We really wanted to believe that gold would go into a 20-year bear market because everybody's looking for $3,000 gold. We said, no, technicals show us the opposite. Okay, so most interesting part was the cycle study showed that bear market 20 years would be followed by a 30-year bull market. I have no idea what would cause a 30-year bull market in gold. Well, now we know infinite money creation. So for that 30 years, year 2000 was the exact low, 20 years after 1980, and cycles are usually not that accurate. They will shift to the right or to the left, but this one was right on the button. So if the bull market now is also correct, it should go to 2030.